welcome to the Ronel Talks Money Show. Now, today I have a very exciting topic, and we're going to talk about trusts. And I have a very knowledgeable lady with me today, Thea van der Spy from Trusteeze. And Thea, thanks a lot for joining me today. I quickly want to just read a short bio of Thea, and then I will introduce her further. So Thea van der Spy is a chartered accountant with a master's degree in local and international tax, a registered fiduciary practitioner of South Africa, a master tax practitioner, a trust and estate practitioner, and the founder of Trusteeze, a professional trust practitioner. She also holds a BCom honors degree in industrial psychology. And Thea founded a company that digitized trust administration and accounting called Trusteeze. And then she also published a book called Demystifying Trusts in South Africa to educate role players about a trust. And she's passionate about educating and guiding consumers and trust practitioners. So thanks a lot, Thea, for joining us. So you can hear that we will definitely going into demystifying a trust, which is, to a lot of people, it just sounds complicated, and today is the ideal basically situation where we can just go into it a bit more in more detail, and Thea can explain to us about trusts and what you need to look out for when you have a trust. So thanks for joining me, Thea, and over to you.
Thank you very much for the invite, Ronel. Yes, as you said, I'm very passionate about trusts. I'm very passionate about educating people, because I really think a time has come in South Africa, especially where, you know, you can no longer just rely on your trust service provider, your accountant, your lawyer. A lot of family trusts in South Africa, the mother, the father, the children are trustees on a trust. And you cannot turn a blind eye. You cannot, claim ignorance. You have to understand the trust laws. You have to understand what's expected of you of a trustee. And unless you understand, and unless you actually acting according, in terms of the laws, you may be held personally liable. So it is a very, very onerous role once you accept the role of a trustee. So yeah, lots that you have to think about, but there are a couple of really, really basic things that you can stick to that do not really have to intimidate you to actually accept the role as a trustee, or to actually look at possibly registering a trust for you, for your family. And we can go into it a little bit later. A trust definitely still serves a good purpose. So, one can have a look at, your reason for considering a trust. So, as long as your reason for considering a trust is not tax evasion, a trust definitely has a place in South Africa.
Okay, thank you for that. And just tell me a little bit about your company, Trusteeze. What exactly are you doing?
Yes, Ronel, about 8 years ago, I was just a chartered accountant, got involved in, property development, and then I got involved in the more impactful things. I was a business advisor at Microsoft BizSpark program, and then we met this lady whose dad had 5 trusts, typical multi-trust structures that people are famous for having in South Africa. Her dad died suddenly, and then his business partner stole 50 million rand out of the trusts because the trusts weren't kept up to date. She didn't understand where bank accounts were held. She did not even know which assets were held in the trust. So she literally spent 3 years and eventually resigned her executive role as a marketing executive to actually make sense of her dad's wealth that was supposed to be in the trusts. So when we met her, she said, she hates all people in the financial industry. And when we asked, what happened, she obviously told us a story. And when we left there, I said to my partner, I'm sure one can digitize this. I'm not an IT person, but I was helping the Microsoft guys. Everybody's digitizing everything. So that's how Trusteeze was born, is to help families protect their assets in trusts. And because it's such a daunting word, we really had to find a way where we can educate people, because people have absolutely no idea what they're supposed to do. So we need to educate, we need to guide people, and make it really easy for them, because that's where people fall flat when you look at trust structures. The implementation is lacking, and then we have to discipline people to do what is required in terms of our laws. So we built a system then that helped people, and the system evolved where we now make it available to typically accountants, trust service providers, attorneys, to use the system, in conjunction with their clients, to make sure that the trusts remain compliant. Because we needed to find a way where everybody's helping you to make sure your trust is compliant. And the trustee, as I said, earlier, has to play an active role in managing the trust. So you cannot, entrust your trust with some trust service provider and you're just not involved at all. So we have to demonstrate that you're involved. So that's basically how Trusteeze was born and how it has evolved over years.
Okay, awesome. And tell me a little bit, if we have to explain a trust and a trust concept in layman's terms, how would you explain that to us?
A trust is a really weird animal. It's not a legal entity. So once, we think of a company, a closed corporation, it's nothing like that. A trust is a mere contract. So what it means is you always have to look at the trust deed, what it allows you to do, normal contractual terms, between the founder and the trustees in terms of what the wishes of the founder were, what he expects the trustees to do, what powers they have in the trust deed. Can they buy assets, sell assets, rent properties? Can they incur debt? Those kind of powers that would obviously complement the founder's wishes. And in terms of that contract, you would always have to have a look at how people are supposed to have meetings. What's the minimum, maximum number of trustees? When can the trust deed be amended? So everything in a trust revolves around that contract. So it's a very kind of a fuzzy term. At the same time, although it's not a legal entity, it actually requires more administration and compliance compared to a company or closed corporation. There are a number of court cases that actually state that a trust is run by resolution. So for every single transaction actually in the trust, you have to have a resolution. So that's a massive admin burden. So because the trust is just a contract, one would always have to comply with that contract. And all the assets would obviously be protected in that trust, for different reasons. The purpose of a trust could either be while you're alive to protect your assets, because a trust is a completely separate entity. It has to run, separate from yourself, which means if something happens to you in your personal name, then creditors can't penetrate the trust, given obviously that you haven't treated the trust assets as if it's your own. That's just a different argument. So you see there's a lot of attacks on trust lately because people haven't really treated the assets in the trust as being separate from themselves. So you have to be very careful that you do treat it as separately from yourself. But yes, one of the advantages is asset protection while you're alive from creditors specifically. And remember, your soon-to-be ex-spouse is also a potential creditor. So, we see a lot of court cases revolving around people get divorced and your spouse becoming a creditor.
I can imagine.
Yes, so asset protection during your life. A lot of estates are just not liquid. So we know about freezing bank accounts, cash issues, immediately after death. So in a trust, you can create that liquidity to kind of support the family after death. Obviously, it creates continuity because all the assets are already in the trust. The moment something happens to you and you pass away, the very next day, the trust just carries on running, like it used to run the day before. So there's no stop in terms of, running the affairs of the trust, when somebody dies, such as the founder or one of the trustees. And there are still estate, planning opportunities utilizing a trust. Obviously, there are various angles of attack, which we won't go into today. So you just need to make sure that you keep your eyes wide open when you use a trust as an estate planning vehicle. But there are certainly still benefits, to use it from an estate planning point of view. So a trust you really use when you've got a family, to leave a legacy of love. We don't want to create a mess, when somebody dies. So it's really just sort things out and protect those assets that you have, potentially for further generations. Because remember, when you die and the assets are on your personal name, you pay in excess of 30% of taxes, death costs, estate duty, which is a horrible number. And as I say, a lot of estates are not liquid, so people don't make provision for it. So for example, you just have a couple of really nice properties. You really want that to go over to your children, when something happens to you upon your death. The executor literally has to liquidate, sufficient assets to pay all those taxes. And as I say, it could be in excess of 30%. So, you could end up losing assets that you never intend to lose upon your death. So a trust definitely serves a purpose, and it is just a contract. So you have to be very careful that you implement it correctly.
Absolutely. And Selma, you have mentioned now a couple of the benefits of a trust, but what are the potential disadvantages or the cons that people should also be aware of?
Yes. I've recently done a webinar where say trust is mine, still mine. I think that's the biggest problem us South Africans have. You just cannot relinquish control. You want to keep control over your assets, right? So you're happy to listen to your lawyer, your accountant to place your assets in trust, but you want to control it. So you are not entertaining the so-called independent trustees. You're not entertaining your spouse, your children, your friend, whoever else you placed as a trustee on that trust. I want to decide over my assets. So I think that is one of the biggest, let's call them disadvantages. You have to relinquish control, which means you have to, work with a board of trustees to execute the trust and decide over those assets. So unless you're happy to and prepared to do that, to actually unlock those advantages that we spoke about, you really need to think twice, because that is a big no-no, is to just keep carrying on pretending it's your assets and you just do with it, as you please. So that is the one big, let's call it, disadvantage of moving your assets out of personal name into a trust. I have spoken about the administration burden. That's definitely, one of the, difficulties is we have to demonstrate that this trust has been run properly. And a lot of people just not inclined to, spend a lot of effort, extra effort to protect their assets and to create that legacy of love to, spend too much time on administration. So that's also one of the downsides. And then, there's a cost involved. So I'm not saying you should pay, kind of through your neck for something. A trust is also not something where, the cheapest that you get it, is the best deal. You are playing with your life and with your legacy. So be very mindful when you look at costs to actually create the trust and then to administer the trust. So, there is an extra cost. So, that is also one of the cons of, putting such a structure into place. So yeah, Ronel, I would think those are the main things that people have to be mindful of. I'm not saying it should, distract you from registering a trust, but you really definitely need to be mindful of those.
Yeah, you definitely need to see the bigger picture and really make sure that it does fit into what your end goal is, and not only just be kind of too short-sighted when you think about it.
And that's why it's so important to always understand a trust is not some loose standing structure. It has to form part of your estate plan. So that's where you start. You think about your estate plan. Does a trust fit into your estate plan? a lot of people with younger children, are not even aware that the moment you don't, have a trust upon your death and you want to bequeath it to your minor children, literally the inheritance has to be liquidated to a large degree, and that money has to be paid into the guardian's fund. Now, they say about 70% of people in South Africa don't have wills. So you can just imagine if younger people, something happens to younger parents. And then if you haven't made provision for a testamentary trust, which a lot of younger people do because you think you're not rich enough to have a trust while you're alive. So, then to get around, not having to pay money to the guardian's fund, people then create a testamentary trust in their wills, which means the trust only gets created upon your death, and then typically, the money would go into that testamentary trust for the minor children. So that's how a testamentary trust gets created. But unless you have that, there's about 40 billion rand lying in the guardian's fund. So it just shows you how few people are aware of this. Now, to go to government to ask for money to look after your child, I think you really need to think twice. And I think it is pretty reckless to not make an effort to at least have a will that creates a testamentary trust upon your death, or start a trust during your lifetime. A lot of people say, I'm not rich enough, a trust is not for me. I always say the right time to think about a trust as part of your estate plan is when you're going to be rich one day. You don't want to make the money first and then think, right, now I'm ready to have a trust. Because of all the attacks by government with all sorts of taxes, the right time to register trust is once you start building wealth, because you want to create and grow the wealth in the trust. The moment you've created that wealth in your personal name first, and now we want to put it into a trust, that's where the trouble starts, because then SARS is saying, hey, but you're just trying to get away from all sorts of taxes, including estate duty, etc., etc. So now we are looking at a way to tax you to penetrate that growth that may happen in the trust, the estate planning benefits that I spoke about earlier. So SARS doesn't like growth of an estate to happen in a trust. They want piece of that pie when people die. So be careful. The right time to think about a trust is when you're going to have a lot of money one day, or not even a lot of money. As I say, you may want to protect your assets, which is not always about tax. So, if you run your own business and you have to sign sureties, it may be a very good consideration to think about having a trust and at least place your personal assets in the trust to protect it, from creditors coming after you if you have signed that surety in your personal name.
Yeah, I know my sister and myself, we are looking into expanding our property portfolio, and they have also encouraged us to set up a trust and then go basically from a trust through a company owning the properties. So what's your view on that?
Absolutely. So as I say, an entrepreneur, I think it's very dangerous given, where we are in the world with the markets and the financial risk we're all running. A trust is a completely separate person from yourself. So if anything happens to you in your personal name, accreditors come after you, you sign sureties with the banks, your business goes under and people come after you in your personal capacity, they cannot touch, the assets in the trust. And I think it's very important to just emphasize again, I want to put the disclaimer, if the trust has been run properly. The courts have opened that door now to say, if people haven't really treated the trust as a separate entity, creditors can now penetrate that trust. So I think it's a very good option to look at a trust. And then obviously from a structuring point of view, not to go into too much detail, obviously a trust is the highest taxpayer in the country at the moment. And you'll see a lot of the media articles, people say, trust, the writing is on the wall because it's such a, high taxpayer entity. In comparison, trusts pay from the first rand 45% income tax, We know in South Africa we've got a progressive sliding scale. So for individuals, you only pay 45%, as a marginal rate when you earn quite a lot of money. The capital gains tax rate in a trust is flat 36%. In individuals, it's a maximum of 18%. So you can see it's a half there. So that's when people are looking now at maybe to protect our value in the trust. Maybe we want to then look at how we can structure so to protect the value in the trust. And that's when they introduce a company under the trust. So the company is established to keep the properties, and then the company is held by the trust, the shares 100%. So you can see you get the same asset protection because your value and your growth and your asset is protected in the trust. However, in your company, you've got a much lower tax rate. Remember, I said in a trust, you pay 45% income tax from the first rand. In a company, it's 28%. So it's a much lower percentage. For capital gains, 22.4% in a company and 36% in a trust. So you can see the differences in the rates. Just be careful. Once you make profits, try and keep the profits in the company and reinvest it there, because obviously the moment you declare a dividend out to the trust, then we add another 20% dividends tax. So then we're pushing that that percentage higher. For capital gains, it's over 37%. Then you can see you're over 37%. Then it's more than the 36 that you had in the trust. And from an income tax point of view, obviously, from 28, you're transferring that then over to the trust. So it's all about planning, and you have to, best you can, understand what is your long-term objectives, what are your long-term or your requirements for cash. If you having that property portfolio to generate cash to live off from, maybe a company is not such a great idea, because then rather keep the portfolio directly in the trust. Because without getting too technical, the trust still has that beautiful principle where we can literally take the income and the capital gains in a trust, and instead of the trust paying the taxes at that high rate, we can now take that whole income or the whole capital gain and distribute it to beneficiaries, and still let the beneficiaries pay the taxes at their lower rates. So you don't want to lose that. So you can only do that if the assets are held directly in the trust. And then you distribute using, they call it the conduit principle, using the conduit principle to then, move the tax liability to the respective beneficiaries. And people are beautifully making use of, say you've got plenty children, you can use, they call it income splitting. And because we're on the progressive tax scale, the more children you have, obviously none of them hopefully are paying tax, so you can register them as taxpayers, and then we split that income in the trust. And we know, like the first, I can't remember, the 80,000 odd, we get as a tax-free amount that people don't pay income tax on. So we can literally, for each child, give them 80,000 rand without paying any taxes. So there are planning opportunities in a trust. But, that will only be if you need that cash to live from. If you just want to do a property investment, keep it in a portfolio and want to reinvest in the longer term, it's a good suggestion to have a company that keeps these assets, protect them in the trust by let the trust keep the shares. And it doesn't stop you from, if you need money, it doesn't mean you're stuck in the structure, you can't get cash, you're just going to pay a higher tax, because now you're going to extract the income after tax into the trust, on which you would then pay dividends tax.
I think as you explain it just emphasizes how important it is that people really do research before they start off with any kind of venture, and that they do get experts in to really, advise and guide them in terms of all these things, because it is complicated. It is just not kind of something that we deal with on a daily basis. You need to dig deeper and really understand all the pros and the cons and all the requirements. But while we're talking about the requirements now, you have mentioned about the trust deed, but what other kind of legal requirements are involved that we need to be aware of?
Yes. So when you look at the legislation in South Africa, it's really very, very thin. And I think that's why a lot of people abuse it so much. We basically have the Trust Property Control Act, which is a very old piece of legislation. It dates back to 1988. And it does not make provision for, the level of information and regulation that we require to do things properly. It basically has administrative, provisions, which is just not sufficient to run a trust properly. So therefore, people had to go to court to get legal precedent. So all the court cases create legal precedent, which means the courts are saying this is what is acceptable to us, or this is what's not acceptable to us. So you have to comply with the legal precedent, and you have to comply then with the legislation, of which the main piece is the Trust Property Control Act. So you have to understand that. And then, in terms of the Income Tax Act, it has now defined a trust as a person in the Income Tax Act, which means every trust has to have, be registered for income tax and submit tax returns. So that's a piece of legislation that trustees also have to be mindful of. So yeah, I think those are the main ones, and then obviously the general principles of contracting, because the trust is just a contract.
Yeah, I think that's important that you mention about the tax returns, because I think that is also something that you would just generally think that's probably only, kind of a requirement much later, not really kind of an annual type of requirement. So that's definitely something to be aware of. But there's quite a lot of various different trusts that's available. So maybe if you can just briefly explain to us the various different types of trusts.
Yes. So I think once you understand what your objectives are and you've created your estate plan, I mentioned earlier the two main types of trust are a testamentary trust, which only comes into existence upon your death. So you would find those trust provisions in your will. So your will would, almost become like your trust deed upon your death. A lot of wills are just not making sufficient provision for trust terms, and often the courts can't find enough substance to create a trust. So it's very important when you create a testamentary trust in your will that it contains sufficient provisions. So that's the one type of a trust. Obviously, upon your death, it gets registered. It typically, is for minors who can't inherit yet. So once they reach the age of 25, some of these will stipulate that the trust would come to an end, and then the children would receive the trust assets. It could also be a trust in perpetuity. Doesn't have to have an end date. So that's a testamentary trust. Then you have your inter vivos trust. That is a trust that you create during your lifetime. So that's what it stands for, inter vivos trust. And, both of those trusts, can again be classified as a discretionary trust, which means you are giving the trustees 100% discretion to treat the assets, to the best of their ability for the benefit of the beneficiaries, which means they can literally give one of the beneficiaries all the distributions if they believe, they are acting in the best interest of all the beneficiaries, or they could have, dish up the income or the expense and the capital gains, in certain percentages to individuals. And then on the other hand, you get a vested trust. So vested trust means that the assets actually belong to the beneficiaries. All the trustees can do is they are just administering it on behalf of the beneficiaries. So having a vested trust versus a discretionary trust, and that's why it is so important to get the wording 100%, and make 100% sure you understand what it means, because a vested trust, the assets physically belong to the beneficiaries, which means if something happens to the beneficiary, then his or her creditors can come after the trust assets, or his assets held in trust. So a vested trust is a very dangerous concept, because of you not getting away from creditors attaching those assets. So upon death, those assets would then fall into the estate of the person who's holding those vested assets. Whereas a discretionary trust is 100% discretion. When somebody dies, that beneficiary would just fall away, and so it would go kind of from generation to generation. So those are the two main categories. So the first classification is, do you create a trust upon your death? Testamentary. Do you create a trust during your lifetime? Inter vivos. Then both of those could either be a discretionary trust, where you give trustees absolute discretion, and you don't want SARS or creditors to turn around and prove that it's actually a vested trust, and therefore they can penetrate the assets. You want to make sure your wording in your trust deed is very clear, but again, then you can't expect the trustees to treat beneficiaries equally. They literally have discretion to deal with assets the way they wish. And then it's so important to choose your trustees correctly, because you're giving them that discretion. So yeah, everything is just so interlinked. But as you said, Ronel, it's so important to understand enough, to understand with what option you choose, what are the pros and what are the cons, and what are the things to look out for.
And once you now understand everything and you are happy that it fits your requirements and what your bigger purpose is, and you decide, okay, I want to register a trust now, what is the process that you will follow to register a trust?
Yes. So in South Africa, you get typically the lawyers, the accountants. There are specialized trust service providers. As I said, that is something that you don't get as cheap as possible. So please don't shop around for the cheapest price, because it is 10 to 1 a trust deed that gets copied and pasted. Probably your name gets inserted in your ID number and the new name, the name of the new trust, and hit the print button. You want to run away from those people. So unless the trust is tailored to your personal circumstances, and I can't stress it enough, that you are making sure that your objectives that you set out before you involved a professional to draft your trust deed, make 100% sure that once that deed is drafted, it does actually say what you want it to say. A lot of people have never read their trust deed, so they don't even know what's in there. A lot of the time, what's in the trust deed is so not what you wanted. I've seen absolutely horror stories where, people have never read it. They would send the trust deed to us to read. And when you share what you've read with a person, they say that can't be, that's never what I wanted, but it's not what you wanted,
Scary.
but you found 10, 15 years ago. So, you can't claim ignorance. You sometimes, the trustee in the trust, how are you going to tell a court, sorry, I've actually never read the trust deed, So it's so important to make sure that you get the right service provider, somebody that does not give a one-size-fits-all trust deed. A trust deed is not something that is a stock standard vanilla trust deed. You have to discuss options with the family, because every family is different. Every person's circumstances are different. The purpose for having the trust is different. So it's so important to make sure it suits your needs, your requirements, and obviously your family circumstances.
Yeah, Fionn, we've discussed now a bit about the tax requirements that you need to submit returns on an annual basis, but what's the requirements in terms of accounting and auditing?
Yeah. I've recently written an article where a lot of South Africans believe if you have financial statements, your trust is compliant. So financial statements does not mean trust compliance. The Trust Property Control Act does not even require financial statements. It requires from the trustees, in terms of the Trust Property Control Act, to keep proper books of account And because of such old wording, the legal fraternity translated that into the trustees have to have an updated asset register that explains which assets are held by the trustees. It has to explain its location of each asset, the market values, etc., etc. So, financial statements are not demonstrating trust compliance. However, you need financial information to complete your tax returns. And it's obviously, a format that typically people would report financial numbers in. So often, the outcome is financial statements. But as I say, financial statements does not mean trust compliance. And the format, obviously, of these financial, the bookkeeping, as the Trust Public Control Act speaks about, does not stipulate any requirements in terms of has to meet any accounting standards or any reporting format. As long as it contains the information that is required to report on a trust. So we often see financial statements that look like a set of farming statements. So, I think make sure you have the information that you require. Firstly is to report to the beneficiaries, because you have to report to beneficiaries so that they understand, how much money, was distributed, how much money is owed to them, what did they get during the year. So typically like a beneficiary statement. And then, obviously, sufficient information to complete your tax returns. We in South Africa, SARS uses a connected person rule, which means SARS wants to know which person's close enough to a beneficiary, because a beneficiary to SARS is the start of creating a connected person rule. So anybody that's connected to that beneficiary, by blood and all sorts of other rules, SARS wants to know who has transacted with the trust, because often, those transactions are not market-related, arm's length transactions. Mm-hmm. So you better report that to SARS, and often there are adjustments, etc., that SARS would make, for not reporting, arm's length transactions. So you need that kind of information to, do what you have to do. But financial statements on its own is not a requirement, and often the format that we see just doesn't have all the required information to do what you have to do.
And then I assume that there's also no requirement for it to be audited.
Oh, absolutely, yes. No requirement to be audited. However, again, you have to go back to your trust deed, because the founder can decide that the financial records have to be audited every year to get transparency and, making sure that the accounts are correct. But yeah, I think it's a big cost saver to not have them audited, and it's certainly not a legal requirement. So it's 100% up to the founder. Just make sure you meet the requirements of the trust deed, because we have seen, financial statements that have come out for many, many, many years, never audited, and then we pick up the trust deed and it said, these statements had to be audited. So it can be quite a mission. So make sure your trust deed requires you to do.
Okay, and then we've discussed now in terms of the advantages if you do have children and you want to leave a legacy for them. But what will typically happen when you don't have children and you pass away? Well, just maybe take us through that process in terms of the trust continuing thereafter.
We often have that. So I think, again, a trust is only forming part of your estate plan. So what were your wishes? Do you have siblings? Do you have nephews, nieces? Are you looking after your parents? Because you can fall away before them. So I think it's important to first do your estate planning, and then make sure if something happens to you, that people you have been taking care of, or you're expected to take care of, or want to take care of, that that's reflected correctly in the trust deed. And then also, a lot of charities, etc., you can bring in if you want, to let money end up, in charities' hands. And what's nice then, instead of straight from your will to bequeath money to a charity, you can have a board of trustees who can actually then give monies to trustees, which is building an extra layer of control to make sure the monies do end up in the right hands.
Okay, great. And then I think something that you probably deal with a lot currently is if people do have a trust and now they decide they want to immigrate, what's the impact of that on the trust?
Yes, we often see that obviously with a lot of South Africans immigrating, and the world's become a really small place, so children are sitting all over the world. You have to be very careful where you are going to reside and where you're going to get your new residency. So if the whole family packs up and go, obviously South African trusts can only own South African assets. So to the extent that you require it to still look after South African properties, etc., because the moment you move anything out of a South African trust, whether the trust deed allows to create, trusts internationally, it would trigger taxes. So there's a couple of, things to consider when you actually do your planning, when you're looking at extracting, value out of South Africa. And then you would also have to be very careful where you're going to reside and where you're going to have tax residency in terms of the treatment of international or foreign trusts. Because if you are a beneficiary, especially in the US, Australia, etc., you have to be very careful to be a beneficiary of a South African trust. So some instances it may make sense to wind down the trust. Some instances you may still have South African beneficiaries, and have to cater for the international beneficiaries in a different way. So I think people just need to understand the different taxes worldwide, what the tax implication would be if you, a South African, a beneficiary of a South African trust, and then does it still make sense to keep the South African assets? It may not. And then to look at winding up, but just be mindful then there are taxes and costs involved.
Okay, so you've mentioned now in terms of winding up, but if you now do have a trust and now at some point you realize it doesn't really suit your needs or your purpose, or maybe the landscape is changing so much and you actually want to change that now, or how do you rectify it in terms of, or can you just unwind it, or what's the implications then?
Yeah, I think the starting point is to, again, go back to your trust deed. You have to try and keep these structures flexible. When we create a trust, obviously we're not creating it with the expectation to wind it down anytime soon. But when you create a trust, you have to make provision for all sorts of eventualities, which may include, as you say, deregistering the trust and distributing the assets out. So you have to make sure that your trust deed contains a termination clause, and on what basis it can be terminated. If in the absence of a termination clause and in the absence of the founder being around, remember, because a trust is just a contract, so while you're alive, the contracting parties can change that contract at any time. That's just normal contract law. The moment the founder passes away or is deregistered, if it's a company, then if the trustee doesn't make provision properly for the amendment of a trust or the termination of a trust, you may have to end up going to court to have it terminated. So I think that's your starting point, is create flexibility in your trust deed to allow you, under certain circumstances, to deregister the trust and to unwind it. And then, a lot of people think once you create a trust, that's a static structure and a static document that has to last forever. It's not the case. A trust is like a will. You can change it anytime, as I say, given that the founder is alive, or allowing in the trust deed, once the founder is no longer around, what the requirements are, who can change it, who can't change it. So try and keep your structure flexible, because things do change, you know, legislation change, you know, landscapes change, individual needs, family circumstances change, you know, people get divorced. So you may want to restructure. And a good time is just every year, beginning of the year, when you have your New Year's resolution, just grab your will, grab your trust deed, quickly scan it. You know, if you read it once a year, you're going to have a pretty good idea what's required of you as a trustee. So it's just good discipline. It's beginning of the year, quickly scan both. And if there are changes, you can make changes. If it's changes to the extent that you want to wind down, you know, have the flexibility in there, and you know, so just create the possibility then to wind it down.
Okay, and then tell me, I think a lot of times people have this perception that a trust can is good in terms of tax savings, and you actually needed to pay less tax. But now, kind of like, and you have discussed now that the tax rates are actually higher. So that kind of perception is not actually true. It's not kind of a tax saving kind of vehicle. Would you agree with that?
Absolutely. So in the olden days, for the younger generation, you would not believe it, but trusts paid less tax than individuals in the old days. And you can see that from some of the old tax provisions that, you know, they try to work around that and stop people from misusing trust to avoid paying tax or to pay less tax. So I think that's where the perception originally came from, you know, use a trust as a tax planning vehicle. Today, with all the different amendments to the Tax Act from SARS who want to penetrate that trust and get a slice of that pie, you know, upon somebody's death, you know, or just in terms of the growth in the trust over time, you have to be very careful. Do not create a trust to avoid tax. It's just the wrong reason. You're going to be bitten so hard. So have a proper rationale for having a trust. As I said, you know, asset protection, creating liquidity upon your death, leave a legacy of love, create continuity upon your death. You can still have the estate planning, you know, estate taxes and tax advantages, because remember, every time somebody dies, you pay these taxes. With a trust, it never happens. It just goes over from one generation to the next to the next. Just make 100% sure, you know, you do not set it up for tax only, because then it's going to come back to bite you. And the longer you wait, the harder the tax consequences are. Yeah. So if you want to do it for tax, create that trust when you know you're going to be rich one day.
Fia, then coming to my last question, I think we have discussed a lot of different things now, and you gave us so much valuable advice and guidance and things that we need to look out for and things that we need to consider. And I think overall it's still kind of like in tax or complicated. You need to make sure that you do get proper advice and guidance. You can't just, you know, sit around with your friends at the braai and listen to what everybody's saying, and there you go with your new trust or something. So you need, you know, guidance and advice from people who really understand, and you need sound advice when it comes to trusts and setting up structures and all of that. And we will definitely share your contact details and your website for people to get in contact with you when they have questions, or they've decided that this is something that they want to explore, or something that can definitely fit into their kind of financial planning going forward. But just to maybe end off with, where do people typically go to find, like, in sound advice to set up and administer a trust?
Yes. Maybe I should start off by saying, do not assume your accountant or auditor and or a lawyer understands too much about trusts. You have to find somebody who works with us every day, who understands both the legal side of it as well as the tax side of it. because they are interlinked. And, you know, your decision as to structuring may have a massive tax implication. Unless you understand that, you know, it may come back to bite you. So it's very important to look out for people who understand both the legal side of it as well as the tax side. As I say, we're not registering a trust to evade tax, but there are certain tax implications. You know, be very careful for people who run around implementing all sorts of high risk structures, tax structures. So really do your homework and speak to a couple of people. As I say, one thing you should really avoid is trying to do it as cheap as possible. I can't stress that enough. You know, it's not something that you want to save money on by risking your entire estate. There are just so many things that can go wrong. There are so many things that you have to consider. It is not a one size fits all. So, you know, get a couple of quotes, speak to a couple of people, speak to different people. You know, you need to speak to people from a tax angle. You need to speak to the accountants. You need to speak to, you know, the legal guys. Your financial advisor, may give you good advice in terms of structuring of products. And because it's such a multi-functional kind of approach that you have to take, it's important to involve, you know, all those people in your life, you know, to actually sit around the table and kind of come up with a proper solution. A trust is not something that's kind of stand here on the side and you dealing with your financial advisor. He doesn't even know you either have a trust or doesn't even know you're considering a trust. I mean, it forms part of your estate plan. And I think, you know, with that starting point, you know, you need to kind of, you know, surround yourself with great people, even your banker, you know, get as many people, you know, as you believe, and get them all to help you to come up with a solution. Because it's so multifaceted, you know, you have to make sure you cover, you know, most angles that you can possibly cover.
Fia, I totally agree with you. I think even though, you know, we are chartered accountants, but the field is just, you know, it's so big and so wide. So you can just not possibly, you know, specialize in everything. So when it comes to these kind of things, it is important that you get advice and guidance from a specialist in that area who is really dealing with it on a daily basis, because they are close to it. They know all the new amendments, all the new laws coming out, all the new requirements. And I think that is what it is all about, that you are open to, you know, talk to those specialists. But I definitely also agree, you know, talk to different people, get different views, and then make sure that you understand enough about it so that you can make an informed decision, which is the best possible solution for you and your situation. So I want to really thank you for spending some time with us today and just taking us through all of these different things that we need to consider, different types of trusts, what are the pros and the cons. And I really appreciate your insight and all the value that you have shared with us. So I will definitely share your contact details. And then I want to encourage the people listening to this, please get in touch with Thea if you have any more questions. She will definitely be able to help you, to guide you, to direct you. So please get in touch with her. And Thea, thanks so much. It really means a lot, and I'm sure they will be people out there who will, you know, it will just be that little light bulb of, I've never really understood it, now I understand it better, or I'm already in that kind of situation and now I actually understand it better, or I've actually learned something that I can go and, apply. So thanks for joining us, and I wish you well.
Thanks very much, Ronel. Same for you.
Thank you. Keep well, and looking forward to our next chat on the Ronel Talks Money Show.